In recent years, many companies, including household names like Tesco, the London Stock Exchange, Severn Trent, and National Grid, have offered bonds to retail investors. The process of purchase and sale has become more accessible for investors following the launch of the LSE's order book for retail market in 2010. Corporate bonds have a place in a balanced portfolio alongside shares, government bonds, property, and perhaps a smattering of other asset classes. The right mix depends not just on the nature of the assets, but the requirements, age, and tax position of the investor. This is good news because corporate bonds are considered to be among the safer ways of investing in companies. Bond prices tend to be less volatile than those of shares, and their coupon payments tend to be fixed, unlike ordinary share dividends. That can make them a reliable source of income, not always the highest, but dependable. Of course, making bonds easily available doesn't guarantee that all are either suitable for the retail investor or are good value. The same processes of assessing risk and return needs to be made as with any investment. Though the basics of understanding any bond is well within the reach of any investor who already owns shares, there is generally less research available on bonds. If the bond issuer has a credit rating, agencies such as Standard & Poor's and Moody's will produce reports from time to time, but the full details of what might happen in case of a default are only contained in the prospectus, which can be a long and complex document. Having said that, corporate bonds offer a useful way to spread risk and build in known returns as part of an investment portfolio. And with such an enormous choice out there, are good reasons why investors may want to pick a handful of individual bonds rather than just invest in a bond fund. To find out more about bonds at Self-Trade, go to our IPOs and new issues section and view our other bond videos in this series. The value of investments can fall as well as rise, and any income from them is not guaranteed. You should be prepared to lose your investment. Past performance is not a guide to future performance. When buying gilts and/or bonds, you should consider the issuer's credit rating and their ability to repay their debt. This will have a direct bearing on the value of the investment. Should the issuer default, they may not make interest payments or be able to repay your money.